Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining us this afternoon, we have Brian Stutland, Managing Partner at Equity Armor Investments, and Mike Khouw, CNBC contributor and Chief Strategist at OpenInterest.Pro. We're here to discuss what earnings are signaling with the strength of the consumer and how that translates to economic growth. It is great to see the both of you. As always, welcome back to Trade Talks. Brian, let's take a look at some earnings. I think Tesla's a great place to start. It's an auto company, consumer company. There's a lot that you can discern in terms of what's happening with the consumer here.
Sure, we can. And I mean, Elon Musk himself said, we're going to be under like some tough, quote unquote quarters coming ahead, right? And so you look at the numbers there and you saw declining sales numbers, net income actually from auto sales, that portion of Tesla. And I guess, it pops up, it begs the question, is it getting worrisome for the consumer, right? If auto sales are sort of like a leading, luxury kind of item, luxury to like necessity kind of item somewhere in between, and sort of consumer discretionary, and Tesla's sort of like one of the leading automobile manufacturers in the world now, you have to have some level of concern that it isn't just a Tesla specific kind of thing, but more of the consumer maybe slowing down. And when you look at the chart, really consumer discretionary as a whole, XLY, I like looking at that chart there. Look at that versus like the S&P 500, and XLY is basically unchanged down the year, while the rest of the S&P is up. So the consumer, not just Tesla specific, but in general, I think is struggling a little bit. And this could be tariff driven, right? I mean, the tariffs could be sort of, having an effect on how much the consumer buying power is actually out there and how much people can actually raise prices and create more profit margin within their corporate structure. So, that can be a little bit concerning.
Yeah. And so, Mike, Brian is thinking that the consumer activity is under strain, right? So if we go with that thesis, what does this mean for household sentiment?
Yeah, I mean, I first of all, I would say that, Tesla's an interesting one because there's some idiosyncratic things going on there, but supporting sort of the general narrative that consumers are being stretched a little bit is that we are seeing some symptoms of that in other automakers too, right? So we have some companies like Stellantis have seen rising inventories. We've seen a substantial increase, frankly, in dealer incentives and manufacturing incentives on car sales. And we saw a boost, actually. So this is the funny thing, I think, that Brian's actually talking about, is that it's kind of hard to discern the impact of tariffs right now on the consumer because, number one, there were a lot of delays. There were some pricing impacts. So, businesses were trying to accommodate the fact that they might experience these things. So if you take a look at corporate earnings, for example, since the beginning of July this year compared to the year prior, one of the things you're going to observe is that the earnings growth has been about 9%, which is actually even higher than the compound annual growth rate for corporate earnings before that. And you would say, well, how is this possible? One of the things is that if you price in tariffs, but then you don't actually experience them, or you didn't experience as many of them for as long as you thought you would, and this is the first quarter that we've had basically the new administration in for the whole thing, right? So the previous reporting season, part of that, I think the prior administration could take credit for. This is the first, quarterly earnings release where we basically are dealing completely with the new administration. And I think that could be a part of it. But what we do see is a real bifurcation amongst households. So we've seen increases actually in cash on hand, but that's really concentrated towards the upper end. If you look at sort of below median households, they actually are seeing increases in debt, increases in delinquencies. And so I think it's important when we think about household sentiment that there's really two camps, right? There's the above average group, and there's the average and below. And the average and below, I think, are struggling here.
Well, you also have to ask yourself, are consumers pulling back due to sticky inflation or high borrowing costs? I think both scenarios are not helpful when you think about it in terms of overall economic growth. If they're not spending and the consumer is nearly 70% of GDP, that can't bode well for economic growth in theory.
Yeah. Yeah, no, that's exactly right. I think one of the other interesting things is we've had a lot of debate. We've seen the current administration making a big fuss about whether or not the Fed should lower rates, for example. But the truth is, do they really want rates to go lower? First of all, it's not just the chairman who makes that determination. So the Fed funds target rate. And the other thing is that the Fed funds target rate isn't necessarily where consumer borrowing, especially for large ticket items, is going to be priced. So home mortgages, for example, which is one of the things where we've seen a big deviation between median incomes and effective monthly costs, those are priced off the 10-year. And if you actually lower the front end of the curve, you could actually raise the back end. And unless the U.S. government wants to sort of fund everything at the short end of the curve, which is probably not advisable. I think we learned that from Yellen. Then, I think it's more about the administration having somebody to point the finger at. Powell is a convenient punching bag. I don't actually think that Trump wants him out of there, because he won't necessarily get the rate picture he wants regardless of who occupies that seat.
Yeah. Well, let's take this conversation further, Brian. Can the Fed cut rates when markets are at all-time highs? Is that even part of their mandate, right?
Yeah, I mean, we saw Trump meet with Powell just the other day. That was a bit of an awkward meeting, if anybody's watched any of that interaction with the two of them, at the very least. But yeah, I mean, to Mike's point, like Trump's been saying, we need to cut rate. The administration wants to take that front end, and there is some concern that doesn't do anything on the back end. We've seen home builders struggle this year, right? And is lowering rates going to help them out? They've done just as poorly if you look at the charts as XLY and the consumer discretionary. But when you do look at cutting rates here, right, the market is at all-time highs, and you have some people saying there's still a little bit inflation. The market's at all-time highs. Why do we really need to cut rates? To Mike's point, even if Powell wasn't there, whoever's in there is probably not going to cut. But you look at it, over the last, there's been about 7 times, call it, where the market's been within 1% of all-time highs, and the Fed has actually cut rates. That leads to some volatility in the near term, but over the course of a year, actually, the markets on average, according to JP Morgan, have been up about 15%. So it's interesting to cut now. What does that do? That, looks like that would help the market even further, but does the market really need the help? Does the consumer really need the help? Or is this tariff thing just a one-time thing? People are going to have to get used to the new pricing structure, and then we'll move forward from there.
Well, I mean, Mike, to your point earlier, even if you were to get 25 bips, 50 bips, a cut or two this year, that's not going to move the needle. I mean, if anything else, I've seen my savings rates go down. Meanwhile, nothing's been cut yet, right? And I think if we were to get more than that, it would signal that there's an issue with the economy. But beyond that, if it's going to help the government pay off its debt or, have less debt to pay, I think the bigger issue is how about we manage the balance sheet as well? It's not just about cutting rates. I mean, our fiscal policy is unsustainable at the end of the day.
Yeah, well, I mean, obviously we need to cut spending, raise revenues, or some combination of both. One of the things that's going to fuel inflation, of course, is government spending. We often talk about monetary policy. Fiscal policy plays an important role in this. And running $2 trillion deficits, is simply not sustainable. So I would hope to see that we get some progress on that front. Look, what's going to happen if we do get a rate cut? I think that's the important thing for investors to think about. It's not bad for equities. I think we can safely say that if we got a 50 basis point cut in the front end, that's not bad news for equities. To your point, we shouldn't get that unless there's a legitimate economic reason to do it. And what are those reasons? A meaningful drop in inflation accompanied by some symptoms of economic weakness, particularly in labor, right? That's the dual mandate. That's what the Fed's supposed to be focusing on. So if we get anything bigger than that, that's indicative of economic weakness on the labor front, presumably. But we don't see signs of that right now. Labor market's actually quite strong. So I think we would see gold go higher. Mm-hmm. I think we would see, all else equal, I think it's safe to say that the crypto complex would likely go higher. And there's a lot of tailwinds there because, we're actually getting a legitimate regulatory framework around it, which is supportive for that whole complex in general. And Bitcoin specifically. So I think, those assets are going to continue to rise. I think equities would do well. But even if we don't get that rate cut right now, which, everyone sort of got eyes on this meeting, I don't necessarily think that that's bad news for equities. I mean, you can sort of see that because the probability of a rate cut's not that great.
Yeah. Well, Mike, you point out an important caveat in your notes as well, that if you cut too late, you might not be able to prevent any further weakness. Explain what you mean by that.
Well, I mean, the general issue is that, and this is really the handicap that the Fed has, right? So the Fed is essentially trying to navigate a monetary policy so that you don't sort of drive off the road. But the only thing that they can do while they're going down the road is look out of the side and rear windows of the car, right? You don't know what's coming. You can only see what you're passing right at this moment and what has already taken place. And that's a very difficult thing to do. And this is one of the reasons why, number one, we haven't been phenomenal in terms of forecasting recessions, and we haven't been phenomenal at avoiding them either, right? Because usually by the time you figure out what you should have done, you should have done it. So yeah. It's a little bit late. That's just the nature of things when you are sort of navigating policy in this manner.
Yeah, and speaking of too late and making sure you have insurance when things happen, Brian, let's look further out. What are you seeing with the VIX futures curve? What's it indicating?
Yeah, the volatility complex is rather interesting. We've seen the VIX really kind of get into these mid-teens, 15, 16 level and find some support. And then we sort of get some sort of system shock. April, this last time being tariffs maybe being too high, and that really sent the VIX significantly higher. But when you're looking at VIX futures, Jill, you're asking about that. I'm looking at September, October, November, and these things are trading at 20% premium to where the VIX is at. So I think there's some level of concern by volatility traders that they want to own volatility a couple months from now, that some sort of system shock is going to come to the forefront, that the market has sort of run its course significantly higher here in the last couple months, and that we're probably due for some sort of, reset, 3%, 5% pullback in the markets that would send the VIX higher. And I think you see that in the VIX futures. I think that's why they're buying that now, and sort of pushing up and expectations that a volatility event is coming down the pipeline in the next couple months.
Mike, would you agree that VIX is giving a warning sign as well? There's also seasonality to factor into that too.
Yeah, there is seasonality. And of course, we know that September and October tend to be above average volatility. But to Brian's point, if you take a look at comparable periods in prior years, the steepness of the VIX futures curve is significantly higher. In fact, it was really interesting to me. I was taking a look at how the VIX futures curve was priced in February of 2020 and then March of 2020. Why was that an important period of time? Well, of course, that was when we began to realize that we might have a global pandemic on our hands. We hit all-time highs in the S&P on February 19th, I think it was, of 2020. And by March, we kind of realized, all right, there's shutdowns. We've got situations going on in Italy. The longer end of the curve right now, so going out 6 months, out to, Octave, Dec, Jan, in the VIX, is higher now than a comparable portion of the term structure was, if you could believe it, in March of 2020, when we already knew we had a real situation. So clearly volatility traders are pricing in something, as a real possibility in the back half of this year right now.
All right. Appreciate both of your insights. As always, thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.